Don't wait for tomorrow. Live for today. Keep chasing the sunshine and go out and play.
Good evening, everyone, and welcome to another JK Deal Reveal. I'm excited to bring a really particular deal to you this week, and again, let's see if it happens to be a deal or not. But this one will have a particular twist to it, so just stay on your toes as we go through this particular deal reveal. So, for those of you who are basically new to the community, I just wanted to make a little announcement. For those of you who are part of the NFTC or part of the Blueprint Expanded program, next Tuesday, we are doing our Ask Me Anything call. So Tuesday evening, I'll be up here and I'll be answering all the questions for those of you who have been part of the Blueprint Expanded program. So that's the Blueprint, diving deeper in every single topic of the Blueprint and the 200-page workbook. If you have any questions about that, I'll be there to answer all of those questions. So this deal reveal this week, all right, like if you're brand new to these deal reveals, what are we doing? We're taking a deal from the community. It might be yours, it might be hers, it might be ours, and we're going to look at it really, really quickly. We're going to see that it doesn't take a master's degree in mathematics to do this, and that it really doesn't take that much time if we're looking for the right things to quickly filter through the weeds and see if we have a deal here or not. Ideally, we're looking for cash flow in the US, so 4 to 10 times more cash flow than in Canada, and we're investing when and where the numbers make sense, period. So today's deal reveal, I'm gonna do a little bit of foreshadowing. This deal was brought by a bank. Okay, that's all I'm gonna say for now. 997 Nellaview Road in Cleveland Heights, Ohio, which is a suburb on the east side of Cleveland, 44112, asking $118,000. We are going to see, is this a deal or no deal? So at any point, if you think it's a deal, start putting in your reactions, put some thumbs up, right in the Q&A or the chat. That's it, the thumbs right there. That's where you basically say, this is something you would put an offer on. And every week we bring you a deal. And every single one of these deals are real deals from the community. And so if on any particular week there's a deal that suits your fancy, that you'd like to be part of, we are connectors through all this. We want to make deals happen for Canadians and for foreign nationals investing in the US. And so if there's something, if you want to reach out, feel free to just send us an email, info@nowfortomorrow.club. We're here to help. So start the counter. We have 997 Nellaview Road in Cleveland Heights. Is this a deal or no deal at $118,000? So let's go. We start off like every other fairy tale with the address in Google. And if we're following the golden rule of real estate, we need to buy at a discount, meaning we have to buy for less than it's worth. So how much is this property worth? All right. So we can go to Zillow, we can go to realtor.com, we can go to Redfin, we can go to Trulia. Any or all of these websites have some type of algorithm to see how much it's worth. This is a 3-bedroom, 1-bath property, single family home. And really quickly, they shoot a number up here. They say it's worth about $91,000. But what I really like about realtor.com is if you scroll down, you can get right here to the real estimates, and then you see a graph in time of how 3 different data companies, property value data companies, estimate the property's value to be. And we basically see here that we have a range. Actually, it's quite a big range in this particular example, anywhere from $77,000 to $128,000. If you look right here on the left, right? At this point in time, we're here. And if we look at the trend, we're seeing that the property values are going up. And for some reason, property values went down in their algorithms in mid 2022, about a year ago, which is interesting because there were no crashes in the market. There was nothing like this. But this particular trend was going up, and these two were going up until that point. But if we, and this is Cleveland Heights, and we're going to see on the map here, it's actually right on the border of East Cleveland. It's not too far from East Cleveland, which is not the best city. It's a suburb of Cleveland, which is definitely pulling the values down here. But nonetheless, I have confidence in Cleveland Heights, and I do see that these three data trends were going up, and I know there haven't been any crashes in the market. So I would extrapolate, and I would say this probably is worth about 130,000 as an ARV. I have a little bit more knowledge than just data online here, but once you get comfortable in your market, you can do this type of initial assessment of a property's value based on your knowledge and the data you see online. Now, if you see that range was a little unsettling for you, you could also go to Zillow, try to get extra data points into this equation to see what it might be worth. Zillow is saying it's 83,000, surprisingly, and you have a picture of the property. We see the range 63 to 102. So I'm a little bit like, I got a little bit more local knowledge, but maybe I'm off as well, which is why before you actually buy any property, you should have an appraisal, an official appraisal, to make sure that you're buying at a discount. So right now we're probably, I'm fairly confident at my 130 number, but nonetheless, the online data seems to say, actually, Kyle, you're upside down here. You're actually more between 80 and 100, really. Okay. And remember, how much are we buying this property for? 118,000. And we didn't get to this information yet, but it actually does need some work on top of it. Okay, we do need some work on top of it. So we don't have any pictures. You'll notice this is an off-market property, right? It is off-market, and so we don't have any pictures. So obviously that does factor in. We want to ultimately buy and renovate for under its value. So even if it is worth 130, like I'm stating it is, we would have to buy at 118 and renovate for under 130 to buy at a discount to satisfy that first golden rule of real estate. Okay, so there's not much spread, right, already, right? It's not looking so good. Hope you're following me there. Not every deal we bring up is a deal, but we're going to see. Maybe it is, maybe it isn't. The second golden rule is cash flow, right? So if you bought this property for 118, what would be the cash flow? And I think I might be able to get another use out of here, but this is a 3-1. Might be a good idea, depending on the layout of the property, to add another half bathroom in these homes, if possible. Adding a half bath could be as low as 5,000. Generally speaking, about 10,000, you can be all in, add a half bath if the layout suits it, and that could add some value to your property. But here we have the 3-1 as it stands, okay? And look at this, pretty solid rents, all things considered, right? We have 1,200 to 13, almost 1,350, based on a 3-1 number. And I actually don't see our cursor, but I think it's right behind this blue one, actually. So blue, we got some reds that are here, green, there's a nice little spread, lots of blues, so average seems to be good. So if we're bringing in on average 1,300, because this is a house, not an apartment, right? So 1,300 a month, 12 months a year, and we use that 50% rule. In Cleveland Heights, always use that 50% rule. Don't try to use a 55% rule or a 60% rule here. There are utilities that can really change the numbers if you're not shifting that all to the tenants, and the taxes actually can be quite high depending on if you're buying at a discount, if your taxes go up or down. Anyways, use the 50% rule. Don't try to say that the expenses are going to be lower. And so we have about 7,800 a year net operating income off this property. If we use that 50%, you take your gross income, you multiply it by 50%, you get with your net. And if you did buy this property for 118, and we're not even counting the renovation yet, we'd be basically at a 6.6 cap rate, okay? And honestly, really, there's going to be renovation. So let me be a little bit more, let's say renovations cost 22,000. That brings us to 140. So really we're at a 5.6 cap, probably paying a little over market value. I'm in at 140 for something which I think is worth about 130. After you do the renovation, you make it nice. Second goal to real estate is cash flow. So we're buying a 6 or about a 5.6 cap rate. Are we cash flowing? If you're getting a mortgage at 7 or 8%, because you're not a local American, you don't have US credit, and you're using asset-based lending like we teach how to do in the blueprint. If your mortgage is 7.5, 8.5%, and your cap rate is 5.5, are you cash flowing? You're not cash flowing, right? So looking at this, right? We've spent about 5 minutes on this now. Is this a deal or no deal? All right, let me know, because this is a real opportunity that someone can buy or not buy right now. No, I got crickets, right? Okay, what do we say? No deal, Amanda says. Okay, so thank you, Amanda. I guess the chat's disabled again. But nonetheless, it really doesn't look to be like we've seen a lot better deals on this, right? I would say that based on these numbers, it is a below average deal. Paul says no deal as well, okay? So why am I bringing it on the deal reveal? Well, one, first of all, not every deal is a deal. And sometimes you can do some little magic or something can happen that would completely change the numbers. Let me explain. This property actually came to me yesterday morning, and it was an email from a bank. The bank called me and said, Kyle, we have this property. Here's the deal. There's a homeowner that is basically going to lose the property because they're in default of their payments. And so they're willing to walk away. We've already negotiated the deal for you. We're going to let them walk away and make $2,500. They're actually going to leave with some money. And they've got a 40-year mortgage that they've been paying on for 10 years. So they're 10 years on their 11th year of this mortgage. They have a 40-year mortgage at 4.25%. Okay. And PITI payments are $800 a month, meaning taxes, insurance, mortgage, so principal and interest. PITI payments are at $800 a month. $800 a month. We see here that we have about $1,300 a month. That leaves us $500 of cash flow. Not really, because I didn't cover all expenses. Utilities aren't in there. This is single family. You'd probably write up your lease to have the tenants pay for all the utilities. Fine. What about maintenance, right? There's still going to be maintenance, so I would at least budget $100 a month. So that 500, there's really $400 of cash flow. What else? Taxes, insurance, management, right? Management, 10% of rent, remove another $130 off that. So now we're at $207 of cash flow a month. Okay. So suddenly you can see how when there might be terms attached to a deal, this would be a subject to the existing mortgage. We're not assuming this loan, okay? We're just, we're buying it contingent on that debt staying in place, and the owner, well, the seller, is perfectly aware and signing off that they are still on the hook for that mortgage. This is how they get out of a bad situation. Meanwhile, we would come in, we would pay for this property. It comes out to about $16,000. That's how much money we need to bring to the table to buy this property. To come into that debt, that would clear off all the arrears, all the mortgage payments that they missed. And we are jumping in 10 years into a 40-year mortgage, okay? That is non-negligible, all right? And let me take an extra minute. I don't usually spend this much time, but I really want to drive home why this is so powerful. Here we have a mortgage calculator that I love, the cchwebsites.com, and you can put in the parameters of this mortgage. Now, unfortunately, it only goes up to a 35-year, so I'm going to have to do my best giving the idea of what's happening here. But basically, we're jumping 10 years into a 40-year mortgage. That's almost like jumping like eight years into a 8 years into a 35-year mortgage, just to keep the analogy going. 8 years. The original mortgage was about 125. They're currently at 104. That's the mortgage takeover amount, and the interest rate is 4.5%. So if we calculate this, this is actually the amortization schedule of this loan. It looks pretty similar to this, and we're jumping in right around the 8-year mark. So they have already paid $40,000 of interest on this mortgage, and throughout the entire amortization schedule, there's $114,000 of interest that is built into this amortization schedule, and they've already paid about 40,000 of it, right? They've paid more than a third of the entire interest. So now moving forward, every payment that we do, there's a much larger percentage going to principal rather than just going to interest. And as you may know, we're buying cash flow about $270 worth. We could, if we wanted to, accelerate that amortization, if we wanted to, even more, because it's still a 40-year term, and we can accelerate it further and save 6.5 years on this mortgage and save another $20,000 of interest if we wanted to. It's a possibility for this deal. Not that you have to, but you have extra cash flow. So now the question becomes deal or no deal. Deal or no deal. If now it looks like we're buying cash flow suddenly out of thin air because the terms of the deal have completely changed between an 8% traditional acquisition mortgage or a cash purchase, which I agree, numbers would not work with regular financing or cash. They wouldn't. But now that we have these terms in there, is it a deal or no deal? All right, now we got a couple more thumbs up. Now, from a cash flow perspective, looks good, right? We have $250, very low money in the deal, like $15,000 plus the renovations, which we still need to inspect. We need to figure out exactly what all the renovations we need to do in here. But nonetheless, lower money in, amazing mortgage terms, something we could never get under regular circumstances. And we don't have any liability for this debt either. Even if we don't make payments, yes, we'll lose the property and lose the money we put in, but they can't come after us because our name is not on guarantee for this loan. The seller's name will continue to be on the hook for the next 30 years if we don't cash out or pay it off before then. But why would we touch such a low debt? So that the big learning here, or big question to ask, is it okay to overpay for a property? Because we're probably going to be in this property for $140,000, and I'm pretty confident it's worth about $130,000. Is it okay paying $10,000 more than the property's worth if there's terms such as a debt takeover, subject to, etc., that is basically creating cash flow for you along the way? So it's not a perfect deal, because a perfect deal would follow all the golden rules and cash flow like crazy and buy at a discount and blah and blah and blah. But it's a sliding scale, right? Does that slide it enough? I think it does. To pay an extra $10,000 or $15,000 over a property's value, it wouldn't be too crazy. It's not like we're paying $400,000 more, it's $15,000 more, and yet we're probably doubling the cash flow, maybe even tripling what the average property in Cleveland Heights, a property like this, if you bought it in another way, you're probably doubling the cash flow for this type of property, which is nice. And then if you're, for example, doing like we're doing on a lot of our properties now and turning into a short-term rental, Well, there's probably going to be about $3,000 a month coming in income instead of the $1,300 that we put in. And so we're going to go a little bit more on the renovation, a little bit more because we're going to furnish it. So our outlay will probably be into this property for like 160 after everything is done. But the cash flow will be well over $1,000 a month, maybe $1,500 a month on this property. And so now with that particular strategy in mind, you can see, right, that it might work. But we're underwriting the deal first with long-term numbers in mind, right? Even if we slap the long-term tenant with normal numbers with these terms, we're cash flowing. We're paying a little bit more, but the terms are good and we're cash flowing. And then from there, you might have another strategy to further increase your cash flow, further benefit your portfolio and your investors. So with all that being said, deal or no deal, how do we like that? Suddenly, magically, we can overpay for a property and it's still a deal. Careful, caution, do all your numbers, do the full, know what you're getting in for, get it appraised so you know how much it's worth, you know how much you're overpaying, et cetera, et cetera. Make sure your cash flow's there, have a good strategy. You'll know what the short, medium, and long-term plan for the property is. But ultimately, it is my belief that you can overpay and still have a deal on your hands. Proceed with caution, but that's the moral of today's story. So hopefully you enjoyed this. And another big takeaway is when the bank starts calling you with deals on a silver platter like this, like you want to stay in the game long enough. This is a marathon more than a sprint. So that's pretty cool when you get that. And, I didn't hesitate. I basically said, we'll take it, right? Even if I don't know, we'll take it, send the paperwork, let's lock it up. I don't want anybody else looking at this potential opportunity. Lock it up, then we'll have it inspected, we'll get it appraised, and if we need to, we'll send, we'll close in 14 days, we'll close in 10 days, but I'm going to make sure it's a deal before, really making sure that renovation budget is, in check, et cetera, et cetera. But that's what we have. So if you like this, if you'd like to learn more, if you haven't yet attended our Epic Blueprint, that's the foundational training, the 4-day training that gives all the basics of investing in the US as a foreign national, or especially as a Canadian like us. Well, you can catch the recording of the last one we did at this link, n4t.club/blueprint, n4t.club/blueprint. And the next live in Florida is going to be, I think it's October 4th to 8th. So the date has been penciled in. If you'd like to attend to the live one, just mark that in your calendar right now. In the next couple of weeks, this link is going to update to give the order page, but it's not ready yet. So just block your calendar right now, and we are very excited to have you join in person as we go through the blueprint again, and also look at some Florida short-term rental properties like our magical Muggle Mansion. So we're visiting properties, we're doing the short-term rentals in a very competitive market, and we're learning how to do that. So n4t.club/blueprint, that is our deal reveal for today, ladies and gentlemen. Thank you for sticking in. I know it was a little bit longer than usual, but have yourself an amazing evening, and we will see you next time on the deal reveal. Now for tomorrow. Have a great one, everyone.